Well, good morning, good afternoon, depending on where you're coming to us from today. We appreciate you taking the time to join us. I'm Jesse Andrews, regional consultant covering the West for New Frontier. Before we get going, a few housekeeping items. We encourage you to use the Q&A function at the bottom of the screen to submit questions. We're going to try to get to as many of those as we possibly can. If we do not, we will be reaching out to you to answer those questions as we go. Also in the chat function, we're also going to have some Calendly links. If you'd like to schedule an appointment with either myself in the West or David Schubach in the East, we are going to have that feature for you this time. Looks like we have a little bit of screen movement here. If we could pull up the map, that would be great. All right, a little bit of a malfunction there. And then for you that have to drop off or can't join us for the entire webinar, this will also be available on YouTube once we run it through compliance. Today's webinar is titled Not So Great Expectations by Robert. Just seems like after the first 6 months of the year, everybody's a little bit underwhelmed and probably just expecting another quarter of the same. We do have a few polling questions. We encourage you to answer those polling questions as we move through this. Today, I am joined by Chief Investment Officer Robert Michaud, our Senior Research Analyst Joy Zhang. For our agenda today, we're going to start off, we always like to touch on a little bit of our process, and today we're going to talk a little bit about the rebalancing process, how we're unique, how we're different, how our recent rebalance was different than in the past. From then, we're going to be jumping over to performance, where Joy is going to take us through performance of our model portfolios and some models of markets or some performance of markets. And then we'll flip it back over to Robert to take us through, hey, what happened, some perspectives and insights and outlook into the market. And then we're going to wrap it up with some Q&A. So with that, before we turn it over, why don't we go ahead and get well, I believe the first poll question is going to come till afterwards. So in fact, let's go ahead and turn it over to Chief Investment Officer Robert Michaud to go ahead and touch base on our rebalancing process a little bit. Robert, go ahead and take it away.
Thank you, Jesse. All right, so, well, first of all, I want to follow on with what Jesse has said, which is it has been a difficult year. We want to acknowledge that. It's sometimes the old definition of a recession, which you scrolled up there, of 2 bad quarters in a row, really feels appropriate, because it's one bad quarter can happen anytime, but it's when multiple things happen that the double hit is what really gets you down. So we will do our best to have a good webinar in light of not very good markets, and let you know really what's going on. I mean, it has been a number of unexpected events, news that keeps coming in worse than expected, and that's really a market that's almost expecting or a recession, and that's where things are the way where they are now. So let me first give you insights into our investment process. And our investment process, as you know, is builds on the institutional framework. This is really what we do, is we think about what an investor's objective is, and then how to build a risk-targeted core portfolio that really meets that objective as effectively as possible. And so we have this whole efficient frontier of portfolios which will maximize the return or the likelihood of meeting an objective, and minimize the risk or the chance that you won't be meeting your objectives. And that's the general idea. And this is, in the last webinar, I gave a talk on what the optimization process was like, how to invest over a very uncertain future. And this is what we have done. This is where our logo comes from, and where many of our patents and our research is from, is how to build a well-diversified, optimized portfolio, given that there's countless ways that the future could unfold. And if you invest too specifically for any one of them, you're likely to be disappointed. So you want a very well-diversified portfolio to account for many unanticipated events that may happen, like what has happened recently, of course. So today I want to talk really about rebalancing, and part of this is because we just rebalanced quite so many portfolios, as many of our advisors have noticed. And so the first step to thinking about rebalancing is you have to have a concept of what's the updated risk and return estimates. And so in this most recent period, there are certain factors that were driving risk and return estimates. Inflation was much higher. Higher nominal return for many assets can be important, especially for taxable portfolios. There's higher equity risk, but the really elevated risks, as you'll see in some charts later, is in the fixed income side. And fixed income, not just with credit, which is there, but fixed income particularly as it relates to interest rate volatility. So this is higher duration, longer duration assets, longer term fixed income. And for across the spectrum, however much volatility, however much risk a fixed income ETF or any type of bond would get from its interest rate sensitivity is probably easily double what it has been historically. So we wanted to explicitly model the risks associated from interest rate volatility into all of our risk and return estimates and build portfolios that better reflected that. And this is extremely important, especially for conservative investors that have a lot of, proportionately, maybe a little bit more of their risk coming from the fixed income side of their portfolio. It's important that when we build a conservative portfolio, that we're thinking about the whole portfolio and designing something that's really meant for an objective of a conservative investor. We definitely, in this environment, don't just want to arbitrarily throw a lot of bonds at conservative investors. We want to think about all of the relationships between all of the asset classes, and that starts with properly modeling all of the risks. Of course, there's also return, and that's where the yield curve comes in, where the expected return on some of the shorter duration assets compared to longer duration assets is much higher than it has been for a while. So effectively modeling a higher, flatter yield curve is another important component of rebalancing. So once we have the new risk and return estimates, then we want to think about the whole portfolio. And so this is what we think of as a continuous monitoring process. This is part of why we never get to take a vacation when markets are turbulent, because we're every day looking at the portfolios and making sure they have the right risk characteristics. Just conceptually, when you're thinking about how should an asset manager be monitoring your portfolio, it's got to be a continuously monitored process. Many strategic asset managers are known for having maybe a calendar-based rule where every January or sometime like that is when they rebalance their portfolio. And what we like to think of is try to take the best concepts of the whole investing world, and that means bringing the all new information whenever it's available in and incorporate that into the portfolio. And that's part of the rebalancing decision. It can happen really anytime. We also want to make sure that all current information is brought in there. And so the rebalancing decision we think of really as a dual consideration between what's going on with the portfolio, what has changed with the portfolio, mostly from price movements within an investor's portfolio. Some of the price changes that we've seen lately. Joy will talk about that. But equally important is what's going on with the current market environment and what is really the most up-to-date concept of the most efficient, most optimized portfolio for your investors today. And so then we will rebalance when these two considerations mean that an investor is likely to benefit from the portfolio being reallocated, reoptimized, and rebalanced. And so here's a graphic that I like to show, which is that at the start, when an investor first invests with us, they should have a optimized portfolio that's appropriate for that market environment and right on our efficient frontier, maximizing its likelihood of meeting the objectives. Now, what of course happens is that over time, the portfolio will change, prices will change, the portfolio will drift away from where it had been. And if it changes enough, then the overall risk characteristics of the portfolio will start to change. Now we want to compare that to what's going on in the market and what is our new concept of an optimized portfolio. So this is the dual character of how we think about the decision to when we need to update and rebalance a investor's portfolio. Now, this is where our patents and statistics come in. We actually have a statistical test which looks at thousands of different scenarios and then says, what percentage of the time is an investor likely to benefit? And we're looking at the total portfolio characteristics of the portfolio that an investor is in right now and comparing that to the optimized portfolio. So that's really our rebalancing decision. And that's what's happened recently, where enough new information has changed and enough dispersion within the portfolio and the different asset classes and ETFs has occurred that makes it necessary to rebalance. And just to get a little bit more specific, this was just in the last couple of weeks, we have rebalanced our global, US, and multi-asset income portfolios. The overall adjustment is accounting for the higher interest rate volatility in fixed income, credit spreads, inflationary environment, and the high flat yield curve. If you look specifically into the different portfolios that we manage, a theme across all of them is things like short treasuries are relatively less risky and relatively more return compared to a lot of others. And you'll notice that there has been a shift in that direction. Some other things would have emerging risks associated with them, like even mortgage-backed bonds, which in this environment have some specific risk associated with them, and certainly longer-term treasuries and other longer duration bonds have been decreased. These were interestingly decreased significantly in our rebalances in December and January as well, but this is going even further, largely not so much because of risk changes in this case, but more because of the flatter yield curve making shorter duration even more relatively attractive. Within equities, things haven't changed nearly as much, but there has been, for risk purposes, a fairly healthy value tilt. As you know, value has dramatically outperformed growth in this year, and so there will be some changes there. And for multi-asset income investors, and it's our 10-year anniversary of multi-asset income, it's been a very successful strategy over the last 10 years. This means that the investor should expect a higher return, higher yielding, sorry, not return, higher yielding portfolio going forward from multi-asset income. So I'm going to let Joy tell you sort of some of the specific changes, and I think Jesse will first do the transition.
Great. No, thanks for that, Robert. I think the key takeaways there for me is there's a lot of data and information that goes into rebalancing. And something interesting this quarter that I picked up with my conversations from Robert is a lot of time, most of the rebalancing is due to the portfolio shifting off the efficient frontier. And a lot of the rebalance this time was more of the efficient frontier actually moving itself, a lot to do with maybe the Fed raising rates over time. So thanks for that. With that, I think we have a poll question we're going to pop up, and we're going to kick it over to Joy on performance. So how long have the New Frontier MAI portfolios been available to income-seeking investors? A few seconds to answer that question. Go ahead and click your mouse. And with that, we'll turn it over to Joy to get the answers. For those of you, we actually celebrated our 10-year anniversary on June 30th. So officially, we have a 10-year live track record. on our multi-asset income portfolios. And so with that, why don't we go ahead and turn it back over to Joy.
Great. Thank you, Jesse. And thanks everyone for taking time to join us today. I'm Joy, and I'm going to talk about the Q2 performance. And we've recognized that this is a very challenging time for you and your clients. So hopefully in this section, I can provide some perspective on performance and also some talking points to help you going forward. So I will cover asset class performance, index performance, and in the end, I will talk about portfolio performance. So let's get started with fixed income. Here I'm showing the both first quarter and second quarter performance for fixed income. So during the first quarter's webinar, I was talking about how Q1 was an unusually bad quarter for bonds, as markets are pricing in this inflation shock and a much more aggressive Fed than expected. So as a result, even the safest short treasuries went down 2.5% during the first quarter. And going into the second quarter, inflation remains the top concern. We have June CPI, F 9.1% from yesterday. And at the same time, more people are concerned about a higher possibility of a recession. And what that means for the second quarter performance is that both duration and credit were under pressure. So US Ag went down 4.6%, and basically every fixed income underperformed 3-month T-bill. So this is a challenge for fixed income investors and also for managers out there. And stronger dollar also weighed on the performance of emerging bonds and international treasuries. And I believe Robert will talk more on the dollar side. And municipal bonds on the other side held up relatively better during the second quarter. And moving on to the equities. So again, the first and the second quarter performance here, and we can see pretty strong performance contrast. And recession concerns were really harsh on equity markets. Global equities went down 15%, and basically there's nowhere to hide. Equity losses across the board worse than the first quarter. And actually international equities did relatively better than US, with emerging markets leading other markets with a 10% loss. S&P entered bear market in June and closing the quarter with a 16% loss. So having international exposures in our portfolios actually have been beneficial in this time period. Value and high dividends continue to outperform growth. And as Robert mentioned, we have this healthy value tilts across most of our portfolios, which has been helpful to our relative performance. And I also want to highlight 2 positions in our portfolios, US minimum volatility and EFA minimum volatility. So they're low risk equities, and they have been providing this additional stability to our portfolios, and especially for conservative and balanced portfolios. And that is for the asset class performance. So let's take a look at the index level. So here I'm showing the 6 global indices ranging from 2080 to all equity. As many of you have already know about our indices, they are constructed in the same way as our portfolios. So indices reflect our investments in real time. And here I'm showing the second quarter and year-to-date performance against the benchmark, the blended equity and T-bill. So again, this is a rough time. Equities fixed income went down together. So our indices closed the quarter with the negative returns, and they underperformed the blended benchmark. And much of the underperformance were coming from the fixed income side relative to T-bill, as I mentioned earlier. And that is for the index. So let's take a look at our portfolio performance, starting from Global Core. And again, you can access our portfolio performance from the website or from the performance sheets using the links that we will share in the chat box. So for Global Core, there are diversified risk control portfolios designed for long-term total return objective. And this quarter, portfolios went down roughly 6 to up to 15% 2080 experienced less volatility and relatively smaller losses, whereas all equity was more exposed to equity stress. And while short-term frictions cannot be avoided, we always want to zoom out and look at the bigger picture and look at the longer-term performance, which is more important for wealth accumulation. And next, we have tech-sensitive portfolios. So they're constructed with the same investment philosophy as Global Core, but with special attention paid to after-tax total return. So the process features additional tax-adjusted inputs and tax-efficient asset class selection and rebalancing. So for this quarter, tax-sensitive portfolios did modestly better than Global Core, largely helped by the municipal bonds. But if you look at the longer term performance, 3, 5, 10-year, tax-sensitive performed in line with Global Core. And least but not last, we have multi-asset income portfolios. And yes, we're having this 10-year anniversary for multi-asset income. And we're proud to see that portfolios are maintaining this good balance of income stability and capital appreciation. And the process features the yield adjusted returns and adapted asset class selection in response to change in yields environment. So for this quarter, we know dividends did better than other equities, and also high yielding fixed income on the other side trailed the US Ag. So on the portfolio level, what we're seeing is that multi-asset income portfolios overall did better than Global Core and tax sensitive, and performance are relatively similar, across three risk profiles. And the yields provided by three portfolios are looking very attractive, close to 3.9 to 4.6%. And our internal forward-looking yields are expected to be above 4.5% across three portfolios. So in general, this is a difficult time. And I really like the slide from Robert's section, investing for uncertain future. Given the continued high volatility, we want to be diversified, stay risk management, and look for the long-term performance. So that is the end of my performance section. And with that, I'm going to pass it over to Jesse.
Great, Joy. Thank you. Yeah, I think nothing surprising that it was a challenging, second quarter, tailing on the first, but where assets went down in tandem, stocks and bonds in the first quarter, it seemed like stocks were the ones that fell further in the second. And then just pointing back to our multi-asset income, they seem to be the portfolios that held up better. Seems like income securities did very well in the second quarter relative to a broadly diversified portfolio. But again, rear view mirror investing, as a reminder, is not the way to go about it. Let's focus on the windshield, not the rear view mirror. But it's great to see across all portfolios with interest rates coming up, we are going to see more income within the portfolios. And so now let's turn it back over to Robert to give us some insights and perspectives, outlooks, and then once we wrap up here, we'll get into Q&A. So with that, Robert, why don't you take back over for us here?
Thanks, Jesse. All right, so now I want to talk about the big picture. I think everybody's wondering, will there be a recession? What's contributing to the recession? What's going on with interest rates in the markets, and what are the contributing factors and implications? So to start off, the markets already think there's likely to be a recession. I'm showing this weekly returns over the year because there's just been a grinding downward week after week. Something else comes out, which is making us less optimistic about the future, and so this is in some ways the most important signal. Markets don't wait for the NBER to declare a recession. They are always forward-looking. They're always paying attention to every bit of available information that comes out, and they're giving a fairly strong signal out there. Now, that doesn't say that going forward, once the recession happens, everything will get even worse. That's just saying this is the market's best understanding of where things are, which is a whole lot worse than where it was at the beginning of the year. The yield curve in this context, I think, is less important. I'm bringing this up in case we have another weird looking yield curve from some sort of classic, compared to classic textbook, what a yield curve is supposed to look like. It's actually gone down a little bit recently, but it does go up very sharply. This is because they're extremely highly anticipated Fed interest rate increases, but then it actually starts to go down, and that has to do with they think that this will be relative. The yield curve is saying this will be a relatively short period of time where the Fed has to be very aggressively moving, and that there's actually a chance that we will hit a recession, and then the Fed will perhaps be pulling back on interest rates at that time. So this is the unfortunate situation of a lot of the anticipation of poor economic futures has to do with we're deliberately trying to slow down the economy through high interest rates. And so I think if you're looking at the yield curve to predict a recession, you kind of have it backwards. Now, just what is a recession anyway? The old definition used to be 2 quarters of negative GDP, and that emotionally kind of feels right as we're doing a second quarter of a down market webinar. But there is a NBER business cycle dating committee, and they must have a marketing department there because they talk about the 3 Ds of recession, which is depth, diffusion, and duration. And that makes my imagination go wild. And can you have other cute ways of describing it, which I guess I won't bore you with. But the key indicators aren't just what you think of as GDP, but also which is gross domestic product, but also GDI, gross domestic income, which interestingly GDP has been trending negative, but GDI has not quite been negative. So also thinking about employment, production, and consumption is going to paint a different picture than saying, okay, well, technically we're going to be in a recession any day now. So this is the calculation. We're not there yet. Clearly, as far as the diffusion, which is how spread out across the economy this is clearly a very broad economic impact that we're in right now. Duration is more of a question, and the depth is not so much according to how the NBER is looking at data. And just I gave a schematic of the calculation. So GDP is negative, GDI I wouldn't quite call it positive, but it's not that negative, it's slightly positive. Unemployment, as we all know, is extremely strong. And that is a big part of contributing to not being in a recession. Consumption is still fairly strong. So it's the production which is where things are most disappointing right now. So not quite in a recession yet. In terms of what happens if we do get in a recession, we have a lot priced in already. We recently produced a blog about what happens going forward after you enter a bear market. But that's also applicable to what happens going forward at any point of time when there's bad news in the past. And so you can think about the 2020 recession. That was a recession that only lasted 2 months, and from April to May. And as we all remember very well, the market was done predicting the recession in late March. And so starting in March, the market did very well. So actually it would have been the time during the recession when you were technically in the recession, market returns were extremely positive. And that happens a lot. By the time the recession actually gets there, the market is done pricing it in and markets can go up. So don't want to make any explicit market predictions, but this research and almost any research that you look at will say that it's about going forward, and going forward, we don't know what happens. The market has already given us the information up until now, good or bad, but going forward, there always has to be some sort of reason for investors to be incented to investing. That's why when volatility is very high, when people are very uncertain, there tend to be some of the better forward-looking returns. And that's because it's very uncomfortable to invest. Capital is being pulled out of the market, so people willing to invest tend to have a slightly higher return. But it comes with more risk. No free lunch here. So the question always is, are you in the right portfolio now? And is that portfolio going to continue to be the right portfolio going forward? The dollar has been dramatic this year, and that is part of the dynamic of the global economy. It's been up 9.4% this year. And thinking about just big picture economic shifts, that's a big one. That has pros and cons to it. So it has made imports and commodities cheaper. So it means it's been hiding some of the inflation out there inside the US. And it also means that for a lot of international equity markets, which Joy said that have done slightly better than the US market, in local currencies, international markets have actually done dramatically better than the US. It's just been hidden by the rise of the dollar. And so now markets and currencies are integrated. So it's not like the dollar can go down 10% tomorrow and international markets will shoot up. But there is a story, an important thing to keep note of here with the dollar. Inflation. Inflation is the biggest news of all. We recently just saw the highest inflation in 40 years or so, and that's 9.1 for the CPI. The core is a little bit better, but there really isn't a lot of good inflation news at all. If I wanted to say what good news there is, it's not in the data, it's just in what may be coming. So the rate hikes have not yet impacted the supply and demand in the economy very much yet. Supply chains are actually easing a bit. Commodities you've seen have normalized. Even gas prices have come down very recently. That's not in the data yet. Inventory has come up, more reflective of a little bit less demand, a little bit more supply, which is what we need. And then if you look at the 5-year forward inflation, so if you look at what fixed income markets are telling you about the inflation expectations starting 5 years from now and going 5 more years forward from that, it's saying the inflation is expected to only be around 2% in the future. So that means that the markets are putting a lot of faith into the Fed that it will actually be able to hit these targets. Some things that give me pause, though, are housing prices. Housing prices, we all know, are crazy. Anyone talk to their neighbors and they'll hear stories about this. Rents in New York just went up 25% over the last year. The dollar's strength means that we've hidden, some of the inflation has been hidden in terms of commodity and import prices. And if you look at the data, a lot of these sticky inflation measures are rising and likely to continue to rise. Of course, housing is a really big component of that. So I don't want to double count that. So other trends is as weird as it is, there are still huge things going that are dramatically affecting the economy. But I do like to go to Google Trends, and if you haven't gone to Google Trends, you should do it. It's a very interesting way to spend an afternoon, and just type in terms and see how those terms are trending in terms of popularity and what people are paying attention to on the internet. And I think, not surprisingly, Ukraine unfortunately had big interest, and I think people are going to start to tire of it, and hopefully that situation resolves as well as possible. But COVID also, which we, in news that's not news at all, we are all very tired of COVID at this point and ready to move on psychologically and in every other meaningful way. But the virus hasn't completely let go, and certainly places like China are going to continue to have some risks associated with that. I also want to let you know what's going on in the ETF world, because we are an ETF expert. That's part of what we spend a lot of our time doing, is paying a lot of attention to what's going on there. There's, in terms of ETFs versus mutual funds, there is a lawsuit that just got settled for excessive taxes. In crypto world, Bitcoin, everybody's knows has not done well. Cryptocurrencies have not done well, and there's a variety of reasons there. But just in this last quarter, 58% negative return. So at least we weren't investing in Bitcoin in our portfolios, I guess. And the parts, if so, we weren't investing it in our portfolios in part because there's no Bitcoin ETF, and so there's no really good way to be investing in Bitcoin. There are other reasons why we're not investing in Bitcoin too, but that's one of them. And the way that people invest in Bitcoin, a lot of them is through exchanges. And what makes it extra scary is that some of these exchanges have filed bankruptcy, and people aren't sure whether they'll even be able to get their Bitcoin that's worth 58% less than it was before. That might end up getting zero back from that. And in other themes, ESG. ESG is, however you feel about it, has been less popular recently, in part because it's underperformed broad markets. It has no exposure to energy stocks and some of the highest returning types of sectors of the market. And they have seen their first net outflows. So in terms of paying attention to what's going on in ETFs, then we wanted to remind you of that. So then, as far as performance goes, ending on a down note here, stocks and bonds are both down a lot. The thing is that markets actually made sense. If you think of what's going on out there, which is the Fed is aggressively raising rates, interest rates are going up, there's inflation the world is worried about, and to fight this, we're perhaps deliberately going to the brink of recession. It's not entirely clear whether we had the choice or not, but we're choosing to go along with it. And so stocks are priced for recession, and interest rates have gone up, which has really hurt longer duration bonds. And so if you just look inside a portfolio, things have worked, unfortunately, in this case, the way they should. But the relationships between asset classes have held up. The relative volatility of different asset classes, small cap stocks are still riskier than large cap stocks, and value is still a little bit more stable than growth. And so the portfolios have performed consistent with this market situation that we're in. In terms of explaining performance, I said this before, is that the 2020 and 2021 were exceptional, and 2022 would likely be different. It started at very high expectations, so negative surprises and deflated expectations, and pricing for a recession have just hit that much harder given where we started. And treasuries have come up a lot, and this is something we put a lot of effort into thinking about, which is how do treasuries fit inside of a portfolio? And this is just a very quantifiable way that if you look at the top of this curve, the top blue line, like the VIX, but for treasuries, and you can see that treasury volatility is very high. You can also see that the correlation between stocks and bonds hasn't changed that dramatically over time, and we have a flat yield curve. Again, in terms of thinking about going forward, exactly the same picture from last time, but I think it's really important to remind people that inflation has no power in terms of predicting future returns. So I think we're ready for some questions, and I will let Joy and Jesse come back.
Great, Robert. Thank you for that. So a lot of stuff to absorb there, but I thought the most interesting part of all of that is what Robert, when he has a free afternoon, what he spends his time, he said his pleasure is looking at Google Trends. So that was an exciting piece of information. It looks like there's a lot of great stuff out there. Thank you, Robert. Joy's joining us back. We've had a lot of questions come in previous and during the poll, but I think the one that is top of mind that's talked about the most is around treasuries and the long bond. And so there's a lot of concern. You hear a lot of fear out there. Who's right? Warren Buffett always says the safest security in the world are T-bills. So what is our take on the bond, the treasury bond, long, short, and how does that work in a portfolio, or how does it fit in a portfolio at New Frontier?
Yeah, sure. So I think that's a very relevant question. How do we think of treasuries in our portfolios? And this time I want to, answer that question more specifically. So I constructed here three 60/40 portfolios using S&P 500 and long treasuries, intermediate treasuries, and short treasuries ETF for the entire 20-year period. So here in the chart, you can clearly see that in this long time period, long treasuries outperformed other two treasuries and actually other fixed income and has been providing great returns to the portfolio. So returns are great for long treasuries, but what about risk? I think a natural question to ask is that is higher risk in long treasuries justified from the portfolio perspective? So if we can move to the next slide, here I'm showing the standard deviation or the volatility of those three portfolios in several time periods, including time periods of market stress. So you can see here that even though long treasury itself is risky, the entire portfolio, 60/40, actually experienced less volatility in most of those time periods and actually realized the smallest maximum drawdown in this entire 20-year period. So what that tells us is that long treasury itself is risky, but when we think about long treasuries in the entire portfolios because of the negative correlation in the long term, it actually reduces the entire portfolio risk and therefore enhances the risk-adjusted returns. So for us, we never want to isolate one asset class from others and only think about the risk return of that asset class. Instead, we want to think about the portfolio construction, what that means, what that asset class means for the entire portfolio, the risk return. I think that's what matters for U.S. investments. The total portfolio at the end of the day, how do they perform?
Thanks, Joy. Yeah, it's about the portfolio. That's the important point. It's thinking about a asset class individually is totally different from the way it behaves in the portfolio. And that's what I love so much about what Joy just showed us, is that a treasury can be very risky. It can have periods of high return and low return, but if you put it into a portfolio, then does it make the portfolio better or not? And that's the question we ask ourselves for every single asset class that we invest in.
Great insight. Yeah, Robert, I can still remember properly diversified portfolio, you should be able to point it and something on the statement every quarter that didn't work good. So thank you for that. Next question has come up prior and during the poll, so really wanted to address this one. Why has New Frontier continued to commit to foreign investments and long bonds? Well, we've already answered the long bond portion, but why do we buy foreign investments?
Well, there's a difference between the future and the past. And so even if you look backwards, we have had, obviously, these are supposed to be globally diversified portfolios. We're looking into spreading out risk, not just in one region of the world or one risk factor. We're not just a all US, all small cap, all value portfolio, even if that might be my favorite asset class. It's not my favorite way of building a portfolio, and I don't think it's right for most investors. So looking backwards, though, our global balanced portfolio has outperformed quite a few domestic US-only balanced portfolios in spite of the underperformance in the past of international stocks. Now, going forward, how sure are we that US stocks are going to outperform international stocks? If we ever had any compelling reason to think that international stocks were just not a valid investment, were not likely to reward investors, were not efficiently priced, then that would be a reason why we would not be investing in them. This is what we did with investing in China, for instance, which has some positive reasons to invest in it, but we did not think it was a positive asset class. So that's one thing in terms of better diversifying a portfolio. Another thing is that we already have a lot of US. Our more conservative portfolios are tilted towards the US compared to the global market cap weights. And the US is by far the biggest market in the world. So currently there's 62% or something like that of global market cap in the US. Did you want to add to that, Joy?
Yeah, I think also looking at this specific time period, as we know, this is challenging, and your portfolio will win by going down less. And as I already mentioned in my asset class performance section, international equities actually did better than US equities. So you want stability this time, and international exposure actually helped in this special environment.
Yeah, I mean, risks of deglobalization and the dollar all compound with that.
Well, thank you for that one. So the next one, I thought I'd pull one here that came in live here just a few minutes ago from Michael Marangola. How do you quantify that the recession risk is priced in already? And what indicators are you seeing that led to your conclusions?
So I can go first. I think that's a very interesting question. How to quantify recession risk? I think you can look at the investment grade space, and you can look at the credit spreads and the term, the yield curve, the structure of the yield curve. So clearly, equities and bonds are under pressure. And some people say, markets are thinking 50-50 recession by the end of this year or the first half of 2023. Some say 70% has already been priced in. But what that means for investments. So simply put, if you think markets are overpricing recession risk, then you buy the dip. If you think markets are underestimating the risk of recession, then you stay in cash. It is, I think, simple in theory, but practically it's impossible to implement. You never know, when the recession comes, if markets are fully pricing all those information. And the fact of that is markets are in the process of reassessment and repricing every new information when it's available. So in practice, I think we don't want to forecast, we don't want to make directional bets based on some numbers out there. And it's important to really focus on what that means for the long-term investments through diversified allocations.
The market is just hypersensitive to every bit of economic data that's coming in. You can see that every day that there's another bit of news about inflation being more persistent, and that the Fed will likely have to push harder or production going down, then that means that the market's going to react to that immediately.
Great. So next question, Robert, I thought this comes from Michael Bate down in Chandler, Arizona. Hey, how does your inflation outlook differ today, say, than it did 3 months ago when we're looking at portfolios?
It hasn't changed too much. The long-term picture, if you think about what I talked about 5 years out and further, what does inflation look like and what are markets saying about that? That's changed very little. And in fact, it's actually gotten a little bit better in the last few months. And that means that the Fed's gotten more credibility, I suppose, by saying it's willing to do everything imaginable, even have a recession. It used to have a dual mandate of keeping the economy good, employment good, and keeping inflation under control. And it's telling us they don't care about the rest of it. They're just focusing on inflation. And I think about this a little bit like game theory for nuclear war or Centerline Chicken or something like that from a movie from the 1950s, in terms of you want to just convince people you are totally irrational. You don't care about yourself. You don't care about your job. You don't care about your reputation. You're going to do whatever it takes to win this thing. And that's what the Fed is signaling here. And in some ways, that makes us a little bit more optimistic about the future. And I'm hoping that they're just pretending that they're this determined and that they actually wouldn't send us over a cliff just to prove a point of fighting inflation. But it does make me a little bit more optimistic about inflation. That said, the data still is really bad, and things like housing have made me not feel much better about it. So all in all, I'm about where I was 3 months ago.
Great. And I think this question kind of ties into that. Will the Fed raising rates crash the economy, or do you believe that we're going to see a soft landing during this quash of inflation?
It already has, right? It's already decimated stock and bond markets. And so if things happen as expected, then stock and bond markets should be fine. Things never happen as expected exactly. So maybe they'll be a little better, you can hope. Often they're a little bit worse, but I mean, this is what a market expectation is that things going forward should be, on average, moderately rewarding to investors, especially those willing to take the risk.
And then I think this is an important question because we're become very popular as ETFs become more popular because of taxes and our tax optimization process. We have an 18-year track record. This question comes from Neil Orzek. When are tax losses realized within New Frontier's portfolios?
So that depends on your platform. So we, for most of the people that we're talking to, we're a model manager. We do have some direct relationships where we have full discretion and can do tax loss harvesting. But if we don't have full discretion, then we can't do tax loss harvesting. So it would depend on the platform to do that. That said, we pay a lot of attention to what the likely tax basis and tax situation is of every account invested with us. We've actually written software that I think you can get maybe on Frontier Advisor yet if it's out of its beta, but we've written software that will tell you exactly if you invested at this time and with these cash flows, exactly what your cost basis looks like and exactly what the tax consequences of the trade is. So before we trade any tax sensitive portfolios, we will look back, run the analysis for a variety of different investors. We know roughly from our flows when investors have started investing with us, and we care a lot about our long-term investors and what their taxes are like, and not betraying their confidence and giving them a big tax bill for not a very good reason. So we are doing everything we can with the platforms, working with the platforms to give a result as close to a individually managed account as you possibly can get from a model portfolio. And when we do trades, especially when we do trades after it has been less than a year, then we're extra cautious and often do more targeted trades for portfolios. But the overall, we're not tax extremists. The overall benefit after taxes of maximizing after-tax wealth for our investors is what we care about. And that does mean that sometimes we will take, especially long-term capital gains, to give the clients a better portfolio.
Great, and I think we have time for one more. I think this is a refresher, can be a refresher. This comes in from Lester at FSC. Is there a range of allocation of cash that is ever employed as a hedge within the New Frontier portfolios?
Yeah, so we maintain this 2% model allocation to cash across our portfolios. And cash is part of our optimization process, but we don't usually preserve higher allocation to cash than 2%. And just for conservative portfolios, just for risk management, we allocate higher allocation to low risk bonds like short treasuries, short munis, tips, and mortgage like that to manage risk.
Well, and I think that's going to wrap it up for Q&A. If we could just ask one thing of you all, there will be we want to go ahead and take the survey after this. We appreciate your time, value your partnership. For most of you on the call, you probably access this through one of the major platforms like AssetMark or Envestnet through your broker dealer. And then also direct through RIAs, Fidelity, Schwab, TD, Ameritrade. We are direct available for RIAs through the major custodians. Please, if you have any additional questions, reach out to David Schubach in the East or myself in the West. And again, we appreciate your partnership and look forward to a better second half of the year. Thanks for your time.
Thank you.